Global financial markets plummeted in volatile trading sessions today as President Donald Trump announced sweeping new tariff measures targeting additional countries, escalating trade tensions and reigniting fears of a broader international trade war. The Dow Jones Industrial Average fell 847 points, or 2.1%, while the S&P 500 dropped 2.7%, and the Nasdaq Composite tumbled 3.2% as investors fled to safe haven assets amid mounting uncertainty over the administration's increasingly aggressive trade policy. The sell-off began in Asian markets overnight and accelerated through European trading before reaching Wall Street, where all major indices opened sharply lower and continued declining throughout the session. The VIX Volatility Index, often called Wall Street's fear gauge, spiked 34% to its highest level in 3 months as traders scrambled to hedge their positions against further market turbulence. Trump's latest tariff announcement, delivered via social media in the early morning hours, caught markets off guard with its scope and severity. The president declared his intention to impose 35% tariffs on imports from Brazil, Argentina, and several Southeast Asian nations, citing what he termed unfair trade practices and currency manipulation. The move represents a significant expansion of the administration's trade war beyond its primary focus on China and Europe, encompassing countries that collectively account for nearly $180 billion in annual trade with the United States. We will no longer allow foreign nations to take advantage of American workers and businesses, Trump wrote in a series of posts. These massive tariffs will protect our domestic industries and bring manufacturing jobs back to America where they belong. Other countries have been ripping us off for decades, and those days are over. The announcement sent shockwaves through commodity markets, with agricultural futures tumbling as traders anticipated retaliatory measures from affected countries. Soybean futures fell 4.8%, corn dropped 3.2%, and wheat declined 2.9% as investors worried about potential disruptions to key export markets. Energy markets also came under pressure, with crude oil futures falling 3.1% on concerns that escalating trade tensions could dampen global economic growth and reduce demand. Currency markets experienced significant volatility, with the Brazilian real falling 2.8% against the dollar and the Argentine peso declining 3.4%. Several Asian currencies also weakened substantially, with the Thai baht dropping 2.1% and the Malaysian ringgit falling 1.9%. The dollar index, which measures the greenback against a basket of major currencies, initially strengthened before giving back gains as investors questioned the long-term economic impact of the trade escalation. Corporate earnings reports scheduled for release this week are now expected to face increased scrutiny, with analysts and investors looking for guidance on how companies plan to navigate the evolving trade landscape. Several multinational corporations with significant exposure to the newly targeted countries have already seen their stock prices come under severe pressure. Agricultural giant Cargill saw its shares fall 6.2%, while mining company Vale's American Depository Receipts dropped 7.8%. The technology sector, which has been particularly sensitive to trade policy developments, led the market decline, with the Technology Select Sector SPDR fund falling 4.1%. Major tech companies with global supply chains and manufacturing operations faced selling pressure, with investors concerned about potential disruptions to their business models. Semiconductor stocks were hit especially hard, with the Philadelphia Semiconductor Index declining 5.3% as traders worried about the impact on the industry's complex international supply chains. Financial services stocks also declined sharply, with major banks falling on concerns about the potential economic impact of escalating trade tensions. JP Morgan Chase dropped 3.2%, Bank of America fell 2.8%, and Wells Fargo declined 2.4% as investors worried about the implications for economic growth and loan demand. Regional banks, which are often seen as more sensitive to domestic economic conditions, also faced significant selling pressure. The The retail sector experienced mixed trading, with companies heavily dependent on imports from the newly targeted countries seeing their shares decline sharply. Walmart, which sources significant amounts of merchandise from affected regions, fell 2.9%, while Target dropped 2.1%. However, some domestic retailers with limited international exposure managed to post modest gains as investors sought companies that might benefit from reduced foreign competition. Industrial stocks faced particular pressure as investors assessed the potential impact on manufacturing supply chains and export markets. Caterpillar, which generates substantial revenue from international markets, fell 4.7%, while Boeing declined 3.8% on concerns about potential retaliation affecting its aircraft exports. General Electric dropped 3.1% as traders worried about the company's extensive international operations and supply chain complexity. Bond markets rallied strongly as investors fled to safe haven assets, with the yield on the 10-year Treasury note falling 12 basis points to 4.18%. The 2-year Treasury yield declined 8 basis points to 4.2%, flattening the yield curve as traders positioned for potential economic slowdown. Investment-grade corporate bond spreads widened modestly, while high-yield credit spreads expanded more significantly as investors became more risk-averse. Gold prices surged 2.8% to their highest level in 6 weeks as investors sought traditional safe haven assets. Silver also gained strongly, rising 3.4%, while platinum and palladium posted more modest advances. The precious metals rally reflected broader investor anxiety about the economic implications of escalating trade tensions and concerns about currency devaluation in affected countries. International markets had already shown signs of stress during overnight trading, with major Asian indices posting significant declines. Japan's Nikkei 225 fell 2.4%, South Korea's Kospi declined 2.8%, and Hong Kong's Hang Seng Index dropped 3.1%. European markets continued the sell-off, with the FT 100 falling 2%, Germany's DAX declining 2.9%, and France's CAC 40 dropping 2.6%. Economic analysts and policy experts expressed deep concern about the potential consequences of the expanded tariff measures. This represents a significant escalation in the administration's trade policy that could have far-reaching implications for global economic growth, said Sarah Mitchell, chief economist at Global Economic Research. The breadth of countries targeted suggests a fundamental shift toward protectionism that markets are clearly not comfortable with. The International Monetary Fund issued a statement expressing concern about the potential impact on global trade and economic stability. Escalating trade tensions and the proliferation of tariff measures pose significant risks to the global economic recovery, the organization said. We encourage all parties to engage in constructive dialogue to resolve trade disputes through multilateral frameworks. Business groups and trade associations quickly condemned the announcement, warning of negative consequences for American consumers and businesses. The U.S. Chamber of Commerce issued a statement calling the tariffs counterproductive and harmful to American economic interests, while the National Association of Manufacturers warned that the measures could disrupt established supply chains and increase costs for domestic producers. Agricultural organizations expressed particular concern about potential retaliation from affected countries. The American Soybean Association warned that Brazil and Argentina are major agricultural producers that could impose their own tariffs on U.S. farm exports, potentially devastating American farmers who are already struggling with challenging market conditions. This could be catastrophic for American agriculture, said Association President Tom Johnson. We need markets, not trade wars. The announcement also drew criticism from several Republican lawmakers who have traditionally supported free trade policies. Senator Pat Toomey called the tariffs economically destructive, while Representative Kevin Brady warned that they could undermine American competitiveness and hurt consumers through higher prices. However, some populist-oriented Republicans praised the measures as necessary to protect American workers and industries. Democratic leaders were quick to condemn the tariffs, while also expressing concern about the administration's approach to trade policy. House Speaker Nancy Pelosi called the measures reckless and poorly conceived, while Senate Minority Leader Chuck Schumer warned that they could harm American families through higher consumer prices. Several Democratic senators called for congressional hearings on the administration's trade policy. The timing of the announcement has raised questions about the administration's strategic thinking, coming just days before important economic data releases and corporate earnings reports. Some analysts suggested that the president may be seeking to deflect attention from other issues or demonstrate strength ahead of political challenges, though White House officials dismissed such speculation. Market volatility was exacerbated by uncertainty about the implementation timeline and potential scope of the new tariffs. The administration provided few details about which specific products would be affected or when the measures would take effect, leaving traders and businesses to speculate about the potential impact. This uncertainty contributed to the broad-based selling pressure across multiple asset classes and sectors. Currency hedging activity increased dramatically as multinational corporations and investment funds sought to protect against further volatility. Options markets saw heavy trading in puts and volatility products as investors positioned for continued market turbulence. The cost of hedging foreign exchange exposure rose significantly, particularly for currencies of countries targeted by the new tariff measures. Supply chain experts warned that the new tariffs could force companies to undertake costly and time-consuming restructuring of their operations. Many businesses have spent decades building efficient global supply chains, said logistics consultant David Chen. These tariffs could force them to make rapid changes that may not be economically optimal and could take years to fully implement. The announcement comes at a time when global economic growth is already showing signs of moderation, with several major economies reporting weaker than expected data in recent months. The International Monetary Fund recently downgraded its global growth forecast, citing trade tensions as a key risk factor. The new tariff measures are likely to further complicate the global economic outlook and could contribute to additional growth downgrades. Central bank officials around the world are now facing increased pressure to respond to the escalating trade tensions. The Federal Reserve has previously indicated that trade policy uncertainty is a factor in its monetary policy deliberations, and today's market reaction may influence future interest rate decisions. Several emerging market central banks may also be forced to intervene to support their currencies if selling pressure continues. The pharmaceutical and healthcare sectors faced mixed trading as investors assessed the potential impact of the tariffs on drug manufacturing and medical device production. Many pharmaceutical companies have significant manufacturing operations in affected countries, particularly in Southeast Asia, where labor costs are lower and regulatory environments are favorable. Companies with heavy exposure to these regions saw their shares decline, while domestic-focused healthcare companies posted modest gains. Energy companies also experienced volatility as traders weighed the potential impact on global oil and gas markets. Companies with significant operations in Brazil, a major oil producer, faced particular pressure. ExxonMobil fell 2.9%, while Chevron declined 2.4%. However, some domestic energy producers posted modest gains on expectations that reduced foreign competition could benefit US production. The automotive sector, which has become increasingly globalized over recent decades, faced significant selling pressure. General Motors dropped 4.1%, Ford fell 3.7%, and Tesla declined 2.8% as investors worried about potential disruptions to complex international supply chains. Many automotive components are sourced from the newly targeted countries, and any tariffs on these imports could significantly increase production costs. Real estate investment trusts posted mixed results, with some domestic-focused rate benefiting from safe haven demand, while others with international exposure faced selling pressure. The broader real estate sector has been sensitive to trade policy developments due to concerns about their impact on economic growth and business investment. Small-cap stocks, which are generally viewed as more domestically focused, initially outperformed their large-cap counterparts, but eventually succumbed to the broader market sell-off. The Russell 2000 index fell 1.8%, less than the major large-cap indices, but still representing a significant decline. Some analysts suggested that smaller companies might ultimately benefit from reduced foreign competition, though this potential advantage was overshadowed by concerns about the overall economic impact. Market makers and trading firms reported extremely heavy volume throughout the session, with many describing the trading environment as chaotic and unprecedented. High-frequency trading algorithms contributed to the volatility as they responded rapidly to news developments and price movements. Several trading halts were triggered for individual stocks that experienced particularly sharp declines. The market reaction extended beyond traditional financial assets, with cryptocurrency markets also experiencing significant volatility. Bitcoin fell 4.2% as investors moved away from risk assets, while Ethereum declined 5.1%. However, some analysts suggested that digital currencies could eventually benefit if trade tensions continue to escalate and traditional currencies become more volatile. Looking ahead, investors and analysts are closely watching for any signs that other countries may retaliate with their own tariff measures or trade restrictions. Brazil and Argentina have significant agricultural exports to the United States, and any retaliatory tariffs could create additional market volatility and economic disruption. Southeast Asian countries affected by the measures have also indicated they are considering their options for responding to the US actions. The Federal Reserve's next policy meeting has taken on increased significance as investors look for guidance on how trade developments might influence monetary policy. Several Fed officials have previously warned about the economic risks posed by trade uncertainty, and today's market reaction may factor into their deliberations about future interest rate decisions. Corporate executives are now facing difficult decisions about how to respond to the evolving trade environment. Many companies have already begun exploring alternative sourcing options and supply chain configurations, but the latest tariff announcement may accelerate these efforts. Some businesses may choose to pass increased costs on to consumers, while others may absorb the impact through reduced profit margins. As markets closed for the day, the full extent of the economic and financial implications of the new tariff measures remained unclear. However, today's sharp sell-off demonstrated the continued sensitivity of global financial markets to trade policy developments and the challenges facing investors and businesses in an increasingly uncertain international environment. The coming days and weeks are likely to bring additional volatility as markets continue to assess the long-term implications of the administration's expanded trade war strategy.